Good day, fellow investors. I recently did a video and Cromer here says that we get it, you're bearish. On the video where I explained that the current fundamentals don't justify the current market valuations and level because the economy, the debt, the price-earnings ratios, and all that we found in the great data set from JPM. However, he said I'm bearish. I'm not bearish. I just don't like what can happen. And in this video I want to give you my predictions for the market going forward over the next 7 years so that you can see how I see this market, what can happen, and perhaps how that fits you. Now, for the last 2 years, the S&P 500 has been down 11%, but mostly, let's say, flat after the pandemic boom in 2020-2021. We have had some lows, a bear market. However, what will happen forward is very difficult to predict, but we will try to do our best. Because when it comes to investing, it is about doing best what is you, and I'm going to give you the framework so that you can see what is best for you. My opinion is that stocks now, especially US stocks, the most highly priced market in the world, are simply risky. But this doesn't mean there is a crash ahead or that I'm saying doom and gloom, stocks will crash 50%. No, I'm even saying that perhaps the most likely outcome for the S&P 500 in the next 7 years is 10,000 points. Yes, 10,000 points. Call me crazy, let me explain. Now, when it comes to 10,000 points, what has to happen for the S&P 500 to get to 10,000 points? Well, let's first look at the federal finances. The government is borrowing, the deficits are getting larger and larger. The net debt compared to GDP went from 30% in the 70s, 80s to the current 100 and likely going higher at faster rates, especially if we have 2 recessions here and there. The current national debt is $33 billion growing, and this doesn't include all the healthcare, Medicare, whatever care payments that the government has promised but are not included in the current debt. And then when it comes to the scenario for the S&P 500 at 10,000 points, the simple question is, how do you deal with that? Well, you deal with that by giving zero interest rates, printing money, expanding the balance sheet, and perhaps even letting some inflation go higher like they did before tightening fastly. And inflation is now a little bit lower. Their target is 2%, like has been the case for the first 20 years of this century. And now we will see whether they're going to maybe one day say, oh, we're gonna let inflation be at 4% target, not 2%. And let's say let inflation go to 5% to cover the debt of the government and all other huge liabilities in the debt cycle. Still stimulate businesses by giving low rates, thus letting inflation run. In 2030, with inflation, S&P 500 earnings are at 500 points, P ratio of 20 on low rates, and we have 10,000 points for the S&P 500. Okay, this is one scenario that can actually happen. Let me give you my other scenarios. So the first scenario is, and why I'm not investing in the S&P 500, it's, let's say, not a good one for investors. Flat for 7 years, 30% down, flat for 7 years with a crash of 40% or more. I'm giving that a 40% chance in this market. And also we can have the S&P 500 down actually in 2030 by 25% on higher for longer interest rates, real rates, and I'm giving that just a 10% chance because I think sooner or later they'll print like always. And then how much am I being paid for the risk of these negative 50% scenarios? A dividend yield of 163 is not enough to let me speculate on the 10,000 points scenario that I give a 25% chance, a 50% up on things being okay, 25% chance. So we have a 50-50 chance for the S&P 500 to do okay, but while I'm owning it, I'm not happy with this dividend yield. So not for me. And that's what I'm saying when I say it's risky. It's just not for me. You have to see how the risk and reward fits you. I prefer different kind of investments, different kinds of potential. And when I think about 7 years, I think the market is pricing always the current interest rate, the next 2 years. The market doesn't think in 7 years. And that is exactly our opportunity if we think long term. And if you think long term, I think that I'm looking for investors that over the next 7-10 years, let's say 10% chance of flat, double 30% chance, 2 to 3x 30% chance, and up, let's say more than 3x, even if there I prefer 2 times 2x with different cycles in shorter time. In 7 years I usually have 2 cycles. That is an investment that will give me my averages 2 to 3x in 7 years. I have 5 or more of such life cycles. If I do that cycle in, cycle out, then I will be well off over the long term. So that is why I say the S&P 500 is risky, but it can be at 10,000 points. I prefer, as a value investor, lower risk, high reward investments. Thanks for watching. Check my research platform and what I do. I'll see you in the next video.